Everyone's real favorite thing about real estate is debt. And it's powerful, and I'm not a fan of over leveraging, but it sure is the key to putting tax-free cash in your pocket and manipulating the values of properties, especially when combined with these other four things. That's one thing that you'll understand as you get more skilled in this game, is that all these things play against each other, form a unique strategy, and they're fluid on a per property basis. And I think that goes beyond the scope of this guide, which is intended to teach you how to get your first rental property deal, right? Not to be a 8-figure equity investor. You'll get there one day, but I do want to give you a peek into the power of leverage on your properties, especially when combined with mispricing, by showing you a couple properties that we're going to refinance here pretty soon. So we actually just started the process on this 9-unit building that we got for $215 just a month and a half ago, actually. And it's worth a good bit more than $215. We think it's worth about $450, not $250. And our friend here, the old liquor store building that we got for $85, and we're all into for about $130, maybe $135 right now, and probably worth about $300 to $375. We've got this commercial unit that's vacant and remodeled and sitting nicely. That's kind of our thorn in our side, but the property is still worth what the property's worth to some extent using the comparables method, not just the income approach. So we think this thing should be worth about $350. Would be totally fine with an appraisal of $300 though if it happened. Getting into these properties at the prices that we have, of course, tremendous cap rates, right? 16.8 on the 9-unit building, 21.5 upside, and on the 5-unit building, we're looking at a 17.1 with a big vacant storefront, 25 cap upside at our all-in cost once we get that unit filled, hopefully sooner than later. And we just reached out to our lender and said, hey, we got these properties, they're owned free and clear. It's a relationship with a small bank here. What can you do? And we've been kind of pushing a little bit with them, and they obviously want us to take our time. So they said, look, 65% LTV, 4.25, which I'll negotiate, 20-year loan. I don't care what the loan term is. I don't care if the payment's a little bit higher. But this is the key here. We own these properties cash. We got way less than their actual V, the value. They didn't say loan cost. They said loan to value. This bank isn't requiring us to wait for some period of time on this property before they give us a loan for 65% of its appraised value. And on this property, well, we've had it for over a year, so we should get a loan based on its appraised value. This is the cool part. What's 65% of the true value of these properties? Well, property number 1 here is actually worth about $450 times 0.65. That's a loan for $292. We got it for $215. And yeah, it needs some improvements over time as tenants cycle. We'll spend all 77 grand of the extra money we get back. But if you guys aren't catching my drift here, we bought this for $215 cash, and the bank's going to give us a check for $292,000, $292,500, right? Let's say the 500 goes towards an appraisal or something like that. $290,000. That's $75,000 of profits that the bank is paying us in the form of debt just for buying this property, and then they're giving us all our money back 1.5 months after purchasing it, before we've done anything. We have not raised rents yet. We have not improved the property. We've not done anything to this deal. They're just giving us a free property, right? Because it's worth a good bit more. That's the power of leverage. And an extra perk to this whole thing is that debt is not a taxable event. You have to pay it back, right? So the IRS sees you put a check for $292,000 in your account. They don't ask any questions. You mark it up as debt on this particular property, which is why we love it so much. Now, the property is worth, once we improve it, close to $700,000, right? Are we gonna get a loan for 80% of $700,000? Never. We like to be responsible with our debt and stay under leveraged so that banks like us. I think this is a tendency that banks like to see as you accumulate more. Now, when you're newer, getting the full 80% loan on your purchase price, sure, go for it. But as you start to accumulate, they'll want to see you have more cash in your account as a reserve, and they'll want to see your income strong, that your previous years of performance with the properties that you bought with them before are going well on your tax returns, right? So don't deduct too much knick-knack expenses here and there in order to keep your tax basis down. So The power of debt on this is that when your property goes up in value, or if your property is worth more than what you bought it for, at some point the banks don't care. They give you a check. So this property gets us 292. This property, I think it's worth 350, but let's say it lands at 300. Well, what's 300 times 0.65? Another 195. So the bank's going to give us about $500,000 on these two properties, and we will walk away with more money than we're into the properties for, and still be leveraged only 65% loan to value. What does that mean? That means we have 35% equity in the properties versus their appraisal still. We're not maximizing our debt, which means the loan's going to be super big, which means the properties will still cash flow in a healthy way. So really good news for us. Now, when you get that check, that $500,000 on these properties that you got, you can go do whatever you want with it. And what do you think we're going to do with it? We're going to go and buy more properties, right? That are also discounted from market value, just like this. I'll give you an example of one. Actually, I don't have it pulled up, so I'm not going to go and try to give you an example. But we just bought a fourplex for $100,000, all cash. Well, we'll use some of that money to improve these properties, and then we'll go back and use some of the money to improve that fourplex. All right, maybe spend $30,000-$40,000 on it, and we'll probably go get it appraised for $250,000 and go get a loan for every dollar we put into it and not more. Maybe get that $130,000, $140,000 back and keep rolling infinitely, because we're buying these deals at mispriced values. But even if you're not, having access to debt is extremely powerful. What asset besides real estate can you purchase and only pay for 20% of as a down payment, and a bank be okay with it, and the property still consistently makes money without a high risk of loss? The foreclosure rate on residential multifamily is so low, even through the historic real estate crash of 2007, 2008. I've seen notes, like statistics out there, that Fannie Mae, which lends on big multifamily too, not just homeowners' homes, had a 1-ish%, like 1.1 or 1.2% default rate on residential multifamily, even through the great real estate crash, right? So banks feel very good about giving you money on your property. That doesn't mean you should be overeager, but understand that debt is tax-free. Own your property for 30 years, pay it off, go get another tax-free loan. Get a check in your hand, and then just let the property pay that right back down. The tenants pay off the mortgage anyways, right? So use responsibly, but very powerful.